Hi friends, welcome to my channel. In this very first lecture, I am going to teach you financial accounting and reporting basic concepts and terminologies. Basic definitions of accounting. First of all, accounting is the maintenance of daily record of economic activities in such a manner so that it is helpful in preparing specific information regarding business or individuals' financial affairs. And business is any legal and economic activity for which purpose is to earn money. What is economic activity? Any activity which involves money is an economic activity. Transaction. Any dealing between a buyer and a seller which involves money is a transaction. There are two types of transactions. One is cash transaction and other one is credit transaction. Cash transaction is when payment for goods or services is to be made on the spot. For example, a sale of rupees 300 for which you have paid cash on the spot. What is credit transaction? Credit transaction is when payment for the goods or services is to be made in future. For example, a sale of rupees 300 for which payment will be received after 30 days or 15 days or after some time. It is credit transaction. Purchase and purchase return, sale and sale return. What is purchase? Purchase is when a supplier sells something to a business. Okay, and when business returns something to supplier, if he don't like something or a thing with some discrepancies, he returns something to the supplier, that would be purchase return. And when business sells something to customer, that would be counted as sale. And when customer returns something to business, that would be sale return, and it is also called as return inward. And when business returns something to supplier, that would also call as return outward. What is discount or concession? It is deduction in the normal selling price of something. There are two types of discount: trade discount and cash discount. Trade discount is discount which is received by a business on the spot, and it is never entered in the accounting records. Cash discount is the discount which is received at the time of payment. It is the discount which is received in credit transaction, which we have seen in the previous here, credit transaction, because we will pay the amount in future, and when our supplier will give us some discount, that would be called cash discount. There are two types of cash discounts. One is discount received, one is discount allowed. Discount received is when we purchased something, we as a business purchased something, and our supplier allow us some discount, so that would be discount received. And discount allowed is when a business allowed some discount at the time of sale to its customer, that would be discount allowed. Discount received would be treated as our income, while discount allowed would be treated as expense for the business. Creditors or accounts payables. Creditors or accounts payable are those businesses or suppliers to whom amount will be paid in future. Debtors or account receivables, these are those credit customers from whom amount will be received in future. Capital or owner's equity, it is the fund which is provided by the owner to his business. Okay. Liabilities, any amount which is payable to the business is a liability. Payable by the business is liability. For example, capital and other liabilities, because these are the liabilities to the owner. Asset is any source which is kept by business and is expected to earn profit for business. There are two types of assets: tangible assets and intangible assets. Tangible assets which have physical existence, for example, building of the business, office of the building, furniture of the building. And intangible assets are those assets which do not have any physical existence, for example, goodwill and copyrights of the business. Type of tangible assets: there are two types of tangible assets: short term, which are also known as current assets, and long term, which are also called as fixed assets. Short term or current assets are those assets which are used for short period of time. It is usually less than 1 year. For example, goods and cash. Long term assets are those assets which are used for long period of time. For example, more than 1 year. Building, furniture, these are long term assets of the business. Drawings. Drawings are those cash or goods withdrawn by the owner from his business for his personal use. They would be called drawings. Accounting period is a span of time for which the profit or loss and liabilities of assets are calculated, usually for the business. It could be 6 months, annually, semi-annually, or quarterly. Revenue or income: it is the charges of the goods or services provided to customer, received by the customer. Profit is revenue minus expenses out of revenue, which we basically earned. Deducting our all expenses or costs is our profit. Expenses are the cost of generating the revenue, which we less from the total income. And depreciation. Depreciation is the gradually decrease in the value of fixed assets due to its use and normal wear and tear. It is a non-cash expense because it don't have any physical existence for the business. For example, a building could be depreciated at 10% per annum. Usually, land don't have any depreciation. Land is always have appreciation. Okay, building can be depreciated at 5% per annum, 10% per annum, or any random percentage. So now, accounting principles. Separate entity concept is a concept that business and owner are two different entities. Going concern concept: business entity will continue to operate indefinitely. So there is no any specific time duration for any business. That is going concern concept, that business entity will continue to operate for indefinite future time. Dual aspect concept is that every transaction in business has two equal effects and they both should be recorded, either debit or credit. Cost concept. Cost concept is that an asset is always recorded at the cost at which it is acquired instead of recording it at current market price. That asset is always recorded at cost. Money measurement concept: that only those transactions are recorded which can be expressed in terms of money or which involve money. In business, in accounting records, we do not record anything which don't have any money value. Accounting period concept. Accounting period concept is that the life of business is divided into series of equal periods for calculating profits or loss, assets and liabilities. As I discussed it previously, it could be semi-annually, annually, quarterly, as per business requirement. And realization concept. Realization concept is that revenue should be recorded at the time when it is incurred, irrespective of when actual payment is received. So, according to realization concept, we record our credit transactions as receivables because we do not receive money on the spot, and in future our customer will pay us the money. So it is according to this concept. Matching concept. Matching concept is that revenue of a particular period should be offset against expenses incurred in that period to generate that revenue, whether the revenue is received or not. According to this concept, the revenue of a particular period is offset as per the expenses of that particular period. Now, conservatism or prudence concept is that anticipated or expected losses are recorded while expected profit is not recorded. In future, if we assume, if we are looking that there are chances of that business is going to have some loss, so we will record it in our records that there is a provision for loss. But if we are assuming, if we are projecting that there are chances of getting some profits in future, we would not write this in our accounting record. Bad debts. Bad debts is that amount which debtors deny to pay creditors, our account receivables which we do not receive in future. What is provision for bad debts? It is amount which business reserve in advance to cover bad debts. What is consistency concept? Is that there should be consistency in accounting methods being used by the business over the years. In depreciation method, as I discussed previously, if a business is using 10% built-in depreciation, so that should be continue in the whole business periods for future. That doesn't allow that a business is using 5% depreciation in 1 year and then the next year that business is using 10% and the next year business is using 12%. That is not according to consistency concept. Consistency concept says that the business must use 10% depreciation. If the business is using 10%, that depreciation percentage should continue for the whole period. Thank you.